Today was one of the most confusing market sessions I have ever tracked. And I want to tell you something right away. Confusion is not a reason to panic. In markets like this, confusion itself is the signal. Oil went from $119 to $87 in a single session. A $32 swing in a matter of hours. Stocks collapsed in the morning and then ripped higher into the afternoon. Dow futures that were down 945 points at the open finished the session in positive territory. Then Trump came out and said the situation with Iran was going well. Oil fell, stocks bounced, everything reversed inside 8 hours. And through all of it, through the spike to $119 oil, through the crash back to $87, through the stock market recovery, through the presidential statement, silver barely moved. Silver opened near 83. Silver closed near $83. It did not spike when oil hit $119. It did not crash when oil collapsed to $87. It simply sat there while everything else around it went completely insane. I've tracked silver markets for years, and I have never seen a decoupling this precise. And what it means is extremely important. If you are new here, welcome. My name is John O.G. On this channel, I track COMEX vault data, CME margin bulletins, institutional delivery filings, and the real mechanics behind the silver and gold markets. I upload when the data demands it. And today, the data is not just demanding attention. It is telling a story that almost nobody in financial media is even looking at. Subscribe and turn on the bell right now, because what I am going to walk you through explains not just today's price action, but the entire architecture of how silver is being controlled in March 2026. Quick disclaimer before we get into it. Nothing in this video is financial advice. I am a researcher and analyst. Everything presented here comes from publicly available market data, COMEX reports, CME filings, Reuters, the Wall Street Journal, and verified institutional research. Do your own research. Your financial decisions are your responsibility. Now, let's start with the oil story, because you need to understand it completely to see why silver's stillness today is so remarkable. Brent crude hit $119 per barrel this morning. That number sent shockwaves through every trading desk on the planet. Oil at $119 means inflation pressure, potential rate hikes, recession fears, and rising costs across the entire commodity complex. Gold spiked immediately. Stocks crashed. Dow futures dropped 945 points before the New York Open. South Korean markets were already in collapse territory from the previous session. The entire global system was repricing for a $119 oil world. And then Trump spoke. He said the war with Iran was going well and suggested a potential resolution could come sooner than expected. Within hours, oil collapsed. WTI fell from $114 to $87, a $27 to $32 intraday collapse, depending on the contract. Stocks recovered. The Dow erased its losses. Traders who bought the $199 oil spike were completely crushed. Financial media is calling today Manic Monday because it produced one of the most violent single-day oil whiplashes in years. Up $32, down $32, all in one session. Now here's the question I want you to sit with, fam. If oil can swing $32 in a single day based on a single political statement, how is silver sitting perfectly still at $83? Silver is an industrial metal. It is energy intensive to mine and refine. It is an inflation hedge and a monetary metal at the same time. When oil moves this violently, silver normally moves with it. When oil hit $119 this morning, silver should have surged toward $90 or even $95. When oil crashed to $87,000, silver should have followed it lower. But silver didn't either. It stayed at $83 while the entire market went into chaos. That is not normal price behavior. That is controlled price behavior. And today, I can show you exactly who is doing the controlling and why. JP Morgan quietly moved 169 million ounces of silver from the deliverable category inside COMEX vaults into the non-deliverable category. Let me explain why that is one of the most important developments in the silver market right now. COMEX silver vaults operate with two classifications of metal. The first category is registered silver. And this is silver that is certified and available for delivery against a futures contract. If you hold a futures contract and demand physical delivery, registered silver is what you receive. The second category is eligible silver. Eligible silver sits inside the vaults, but it is not currently available for delivery. It has not been designated for contract fulfillment. JP Morgan moved 169 million ounces from registered to eligible. They moved silver from the market pool into their private pool. It still exists inside the vault, but now it cannot be demanded through the futures delivery system. In other words, they put the metal behind a wall. Now let me give you the number that makes this situation extraordinary. COMEX silver open interest currently stands at 244% of registered inventory. That means for every single ounce of silver available for delivery, there are 2.44 futures contracts that could theoretically demand that ounce. The math does not work. Historically, it has never worked because most traders roll their contracts instead of demanding physical metal, but that assumption is beginning to break. In March 2026, 43.1% of contracts on first notice day demanded delivery. That is 3 times the historical average. And this is exactly the moment JP Morgan decided to remove 169 million ounces from the deliverable pool. They did not sell it, they did not deliver it. They simply moved it to a category where nobody can claim it through a futures contract. Think about what that does to the delivery math. When registered inventory shrinks and open interest stays high, the pressure on the remaining deliverable silver increases exponentially. Every ounce removed from the system pushes the exchange closer to a point where delivery obligations cannot be met. Now connect this with the oil story today. This morning, every news channel on Earth was focused on oil hitting $119. Oil banners everywhere. Breaking news alerts everywhere. But while all the cameras were pointed at oil, JP Morgan's vault reclassification was buried deep inside COMEX reporting documents that almost nobody reads. This is how institutional operations work. The distraction lives in the headlines. The real signal lives in the data. While the public watched oil swing wildly, the available silver supply on COMEX quietly got smaller, and the squeeze pressure quietly got larger. Now, let's talk about another signal almost nobody in mainstream finance is discussing: silver lease rates. Lease rates represent the cost to borrow physical silver from a vault. When someone needs to deliver metal they do not own, they borrow it and pay a leasing fee. Under normal market conditions, silver lease rates run between 1% and 3% annually. Right now, lease rates are approaching 30%. That number is extraordinary. It means physical silver available for borrowing is extremely scarce. Institutions are charging enormous premiums just to lend out metal temporarily. When lease rates reach levels like this, the physical market is telling you something very clear. Real silver is becoming difficult to access. And yet the paper market still prices silver at $83. 2 completely different realities. The physical market and the paper market are diverging. And historically, when that happens, the paper price eventually explodes upward to meet physical demand. Now consider JP Morgan's physical accumulation. In the last 2 weeks alone, they took delivery of 12 million ounces of silver through the COMEX system. They did not roll futures contracts. They demanded the metal. 12 million ounces at current prices represents roughly $1 billion worth of physical silver. They also purchased 3 million ounces at $78.29, almost exactly at the recent price bottom.